Welcome to this comprehensive guide on Forex trading. If you're looking to explore the world's largest and most dynamic financial market, you've come to the right place. Forex, short for foreign exchange, is where currencies from across the globe are bought and sold. Every day, this market sees transactions worth over $6 trillion, making it a cornerstone of the global economy and a hub of financial activity. Why is Forex important? Forex isn't just about exchanging money for travel or trade. It's crucial to the global economy as it facilitates international trade, investment, and economic stability. Take, for example, a US-based company that imports goods from Japan. They need to convert dollars to yen to pay the Japanese supplier. Forex provides the infrastructure for such exchanges, ensuring that goods and services flow freely between nations. Without Forex, the world's economies would not be as interconnected as they are today. Similarly, individuals and businesses use Forex for a variety of reasons, whether it's for travel, managing risk in international business, or diversifying investment portfolios. And here's the exciting part. Thanks to the internet and modern platforms, individuals like you can take part in Forex trading. Whether you're looking to hedge against currency fluctuations, take advantage of market trends, or build a profitable trading strategy, the Forex market offers countless opportunities. The Forex market is the largest and most liquid financial market in the world. It operates 24 hours a day, 5 days a week, facilitating the trading of global currencies. Unlike stock markets, where you buy shares of a company, Forex trading involves trading currency pairs, buying one currency while simultaneously selling another. For instance, in the EUR-USD pair, you're trading euros against US dollars. This relationship is essential because the value of one currency fluctuates relative to the other, influenced by various economic, political, and market factors. Let's explore how Forex trading works. If the EUR-USD currency pair is quoted at 1.1 thousand, it means that 1 euro equals 1.10 US dollars. This rate constantly changes due to supply and demand, as well as external factors such as interest rate changes, economic reports, and geopolitical events. Example 1. Predicting currency strength. If you expect the euro to strengthen, increase in value compared to the dollar, you would buy the EUR-USD pair. Conversely, if you believe the dollar will strengthen, you would sell the pair, effectively betting that the euro's value will decline against the dollar. If you buy EUR-USD at 1.1 thousand and later sell it at 1.1050, the 50 pip increase represents your profit. On the other hand, if the pair drops to 1.0950, you would incur a 50 pip loss. Example 2. Real-life application. Imagine you are traveling from the US to Europe. You exchange $1,000 for euros at a rate of 1.1 thousand, receiving 909 euros and 09 cents. A week later, the exchange rate moves to 1.1200. If you exchange your euros back, you'd receive $1,118.18, making a profit of 18 cents, due to the euro's appreciation against the dollar. Key Forex terms you need to know. Understanding Forex terminology is essential for navigating the market effectively. Let's dive into one foundational term. What is a pip? A pip, short for percentage in point, represents the smallest price movement in a currency pair. It's a key measurement for understanding price changes. For most currency pairs, like EUR-USD, a pip is equal to the fourth decimal place, or 0.0001. Example, if EUR-USD moves from 1.1 thousand to 1.110, it has increased by 10 pips. For pairs involving the Japanese yen, like USD-JPY, a pip is measured at the second decimal place, or 0.01. Example, if USD-JPY changes from 110 to 110.10, it has moved by 10 pips. Knowing what a pip is helps traders calculate profits, losses, and risk. In Forex, trades are conducted in standardized amounts known as lots. 1. Standard lot represents 100,000 units of the base currency. 2. Mini lot represents 10,000 units of the base currency. 3. Micro lot represents 1,000 units of the base currency. For example, if you trade a micro lot in EUR-USD, you're managing 1,000 euros. A 1 pip change in the exchange rate would result in a profit or loss of $0.10. This smaller lot size is beneficial for beginners, as it allows for easier management of risk while still understanding how market moves affect your trading. Leverage. Leverage is a powerful tool in Forex trading that allows you to manage larger positions with a smaller amount of capital. For example, with a leverage ratio of 101, a $1,000 investment can control a position worth $100,000. While leverage offers the opportunity for significant profits by amplifying the effect of price movements, it also increases the potential for larger losses. This means that even small market fluctuations can have a substantial impact on your account balance. It's crucial to use leverage carefully, apply effective risk management strategies, and only trade with funds you can afford to lose. Spread. The spread refers to the difference between the bid price, buy, and the ask price, sell, in the Forex market. This is a crucial concept for traders as it directly affects the cost of entering and exiting a trade. For example, if the EUR/USD currency pair has a bid price of 1.1000 and an ask price of 1.102, the spread would be 2 pips. The spread represents an indirect cost, as traders must overcome this difference for a trade to become profitable. It's important to note that the spread can fluctuate based on various factors, including the liquidity of the currency pair, market volatility, and the broker you use. Some brokers offer tighter spreads, while others might have wider spreads, which can impact your overall trading strategy. Additionally, during high volatility or low liquidity periods, spreads may widen, resulting in higher trading costs. Understanding how spreads work and factoring them into your trading plan is key to managing costs effectively and ensuring that your trades are as profitable as possible. Major currency pairs. In the world of Forex trading, the most popular and actively traded currency pairs are known as majors. These pairs are widely available across all major trading platforms due to their high liquidity, making them an attractive option for traders of all skill levels. The major currency pairs include EUR/USD, the euro against the US dollar, the most traded currency pair in the world; GBP/USD, the British pound against the US dollar, often referred to as cable in the trading community; USD/JPY, the US dollar against the Japanese yen. Known for its volatility, this pair is heavily influenced by global economic events and government policies, making it a go-to choice for traders looking for quick moves. AUD/USD, the Australian dollar versus the US dollar. This pair is influenced by commodity prices, as Australia is a major exporter of natural resources. If global demand for commodities shifts, expect fluctuations in this pair. The US dollar against Swiss franc. This is considered a safe haven pair, particularly during times of economic uncertainty. Traders flock to the Swiss franc when there's market instability, driving up the value of the pair. What makes these pairs so popular is their tight spreads and high trading volumes. This translates into lower transaction costs and easier trading, especially for novice traders who benefit from quick and efficient trades. How Forex trading works: currency quotes and spreads. When trading Forex, every currency pair is quoted with 2 prices. 1 bid price, the price at which the market is willing to buy the base currency. 2 ask price, the price at which the market is willing to sell the base currency. For instance, if EUR/USD is quoted as CU1 1.1000, 1.102, this means the bid price is 1.1000, indicating the price buyers are ready to pay for euros. The ask price is 11002, showing the price at which sellers are offering euros. The difference between the 2 prices is known as the spread. In this case, the spread is 2 pips. The spread represents the transaction cost of entering a trade, which every trader must account for. Execution. To trade Forex effectively, the first step is selecting a reliable broker. This broker will serve as your gateway to the Forex market. Popular trading platforms like MetaTrader 4, MT4, and MetaTrader 5, MT5 are widely used by brokers, offering advanced tools for analyzing market data, applying technical indicators, and placing trades seamlessly. When choosing a broker, there are several key factors to consider. First, ensure the broker is regulated by reputable financial authorities such as the FCA, Financial Conduct Authority, ASIC, Australian Securities and Investments Commission, or CSEC, Cyprus Securities and Exchange Commission. Regulation provides a layer of protection and ensures that the broker adheres to strict financial standards. Next, evaluate the broker's trading conditions, such as competitive spreads and low transaction costs. These factors can significantly impact your profitability over time, especially if you're a frequent trader. Finally, prioritize a user-friendly platform that offers efficient execution, reliable market data, and essential features like stop-loss and take-profit orders. A well-designed platform can make your trading experience smoother and help you focus on making informed decisions in the dynamic Forex market. Types of Forex analysis. To trade successfully in the Forex market, understanding the key types of analysis is essential. Each provides unique insights into market behavior, helping you make informed decisions. 1. Fundamental analysis. This approach focuses on economic indicators, central bank policies, and geopolitical events to forecast currency movements. Key elements include interest rates. Higher rates attract investors, boosting a currency's value. GDP growth. A strong economy typically strengthens its currency. Inflation rates. Controlled inflation supports currency stability, while excessive inflation often weakens it. Example, if the Federal Reserve announces a rate hike, the US dollar may rise as investors seek higher returns. Technical analysis. This method dives into the study of price charts and leverages powerful indicators to uncover trends and patterns in market movements. Let's explore some popular tools. Moving averages. These smooth out the noise of price fluctuations, giving you a clearer view of the overall trend. Fibonacci retracements, a favorite for spotting potential support and resistance levels, helping traders predict possible turning points. RSI, Relative Strength Index, a trusted gauge to identify when the market might be overbought or oversold, signaling potential reversals. Sentiment analysis. Sentiment analysis is all about capturing the market's emotional pulse. Are traders leaning toward optimism, driving a bullish outlook, or are they consumed by caution, signaling a bearish mood? This approach acknowledges that market sentiment can be a powerful force behind short-term price movements. Factors like breaking news, economic announcements, or geopolitical events often ignite waves of emotion, influencing buying or selling behavior. By staying in tune with the market's mood, traders can anticipate potential shifts and make more informed decisions about timing their trades. Effective risk management in Forex trading. When it comes to Forex trading, managing risk isn't just important, it's essential for long-term success. Here are 4 key strategies to help you safeguard your capital. 1. Use stop-loss orders. A stop-loss order acts as your safety net, automatically closing a trade if the market moves against you. This ensures you cap potential losses and keep emotions in check. 2. Set take-profit targets. Lock in your gains by defining a take-profit level. This strategy helps you secure profits when the market hits your desired price, avoiding the risk of losing them to sudden reversals. 3. Control position sizing. Only risk a small percentage of your total capital, typically 1 to 2% per trade. This disciplined approach minimizes the impact of a losing trade on your overall account. 4. Be cautious with leverage. Leverage can amplify both profits and losses. Use it wisely to avoid turning minor setbacks into significant financial hits. Example in action. Imagine you have a $10,000 trading account. If you decide to risk that's $100 on a trade with a 50 pip stop loss, your position size should ensure each pip equals $2. This calculated approach keeps your risk in check while allowing for consistent growth. Building a Forex trading strategy, a path to consistent success. Developing a clear, effective strategy is essential for achieving long-term success in Forex trading. Here are some of the most popular approaches. Scalping. This method focuses on making quick profits from small price movements within seconds or minutes. Scalpers require tight spreads and the ability to make fast decisions. Day trading. A strategy where all positions are opened and closed within the same trading day, ensuring no exposure to overnight market risks. Swing trading. This style targets larger price swings, holding positions over several days or weeks. ideal for traders who prefer a more relaxed pace compared to day trading. Backtest your strategy. Before diving into live trading, it's crucial to test your strategy using historical data or a demo account. This will allow you to refine your approach without putting real money at risk. Top tips for beginner Forex traders. 1. Educate yourself. Gain a solid understanding of market dynamics, risk management, and different trading strategies. 2. Start small. Begin with a demo account or trade with minimal capital until you build confidence. 3. Choose a regulated broker. Work with a broker that adheres to industry regulations for transparency and security. 4. Avoid over-leveraging. Excessive leverage can lead to significant losses. Use it wisely. 5. Stay disciplined. Follow your trading plan and avoid making emotional decisions during market fluctuations. Forex trading offers exciting opportunities, but requires a solid foundation of knowledge and discipline. By mastering market analysis, applying effective risk management, and continuously refining your strategy, you can navigate the Forex market with confidence. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and click the bell icon so you never miss out on new tips and strategies that can help you succeed in Forex trading.